Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or alternatively by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Simon Doherty, Head of Managed Portfolio Services at Quilter Cheviot. And this week, I'm pleased to be joined by regular podcast guest Richard Carter, our Head of Fixed Interest Research, and Ben Barringer, Senior Equity Research Analyst covering global technology, communication services, and media. Good morning to you both. Richard, if I turn to you first, a new month and a new quarter with US markets signing off for June with another strong session on Friday. Now, I think if you take a step back, these moves were partially driven by quarter-end exuberance, but also by a key data point watched closely by the Fed, which suggested that inflation pressures are continuing to ease slightly. Can I start by asking you to elaborate upon these latest figures? And do you think they have any bearing on the Fed's next steps?
Yeah, good question, Simon. I don't think they're going to have a massive impact. I mean, you're right. I mean, as everyone will know, there's lots of different inflation measures around, but one of the ones that the Fed focuses on quite closely are these is the PCE index, and that did weaken again on the latest reading, which is encouraging. But the problem for the Fed is that other data points last week, particularly, were still pretty strong, and I would sort of highlight the employment numbers, so that the weekly jobless claims data is still very strong, and also the housing market, which you would kind of think that's one of the most interest rate sensitive sectors, affected by higher rates, seems to have sort of had a bit of a rebound. So I don't think Friday's numbers will have a massive impact. The sort of latest comments from the Fed and from Jay Powell suggest there's at least one more rate hike in the pipeline. Possibly two more, depending on how the data unfolds. So, yeah, as I say, still some way to go for the Fed yet.
Great stuff, thanks. And if we turn back to Friday's gains once again, interesting to note that the session concluded what was one of the best first half periods enjoyed by US stock markets in the past few decades, something that potentially our listeners might not be aware of. And this obviously is despite the plethora of negative headlines that we've seen year to date. Now, something I'm obviously very keen to delve into with Ben as well, given the primacy of the US technology sector in market leadership this year. But Richard, if I can ask you again at the very headline level, what are your key takeaways for investors so far in 2023?
I think that the key takeaway is that the economy has been remarkably, particularly US, has been remarkably resilient in the face of rising interest rates. And there was a lot of doom and gloom around start of the year. Would we see a hard landing and all the rest of it? Well, we haven't. There has been the odd episode like the Silicon Valley Bank situation that suggested, here we are getting towards the end of the cycle, and the Fed tightening is going to cause a few problems now. But that seems to have been dealt with pretty well by regulators, and otherwise the economy has kind of sailed on pretty well, and no sign that of any turn, particularly in the labour market, which remains as strong as ever. So I think we might get there at some point, but for now I think we can take encouragement from what's been obviously a pretty strong quarter for markets.
Yeah, thank you. And certainly a pretty strong quarter for international equities for a UK investor. But on the flip side, obviously one asset class that has continued to struggle in 2023 has been UK government bonds. And, we've seen that through the yields demanded by investors continuing to rise. I think, if you look at the second quarter of this year, it was a challenging one for gilts. And June in particular proved very difficult for bonds with a shorter maturity date. Now, obviously, last week, you, Vanessa, and Will discussed the recent 50 basis point increase in the base rate by the Bank of England's MPC. It would be helpful, I think, for listeners if you could potentially just elaborate upon the relationship with and the impact of these moves on the gilt market, and With yields now above those seen, during last year's mini budget crisis, what do you see next for UK government debt?
Yes, so different parts of the gilt market or bond market generally are affected by different factors. But the short end of the gilt market, if you're talking sort of 0 to 5 year government bonds, very much driven by what the market is expecting in terms of what the Bank of England's going to do. You do have these odd episodes around, like you mentioned, Liz Truss mini budget, where different drivers affect it. But normally the front end, it's all about what the Bank of England's going to be doing. And just as inflation's been a bit sticky a little bit in the US, it's been very, very sticky here. And in fact, on some measures, if you look at core inflation, it's still rising. So the Bank of England is going to have to probably raise rates by more than it has done. As you mentioned, the 50 basis point rise. I think a lot of that was about getting some credibility back on the inflation fighting front, and markets are expecting them to go even further, potentially above 6%. So that's what's driven the move in the front end. I think the outlook from here actually is, I think, fairly positive for bonds, because although inflation is still pretty sticky, things like energy costs, food costs, I think are going to start coming down fairly soon. And the market, to be fair, is already pricing in a lot of bad news in terms of where the Bank of England's potentially going to put rates. And I think, if we do see interest rates go up as high as 6%, then the impact on people's mortgages is going to be pretty extreme. So I think you're right. Bonds had a bad quarter, gilts had a bad quarter in Q2, but hopefully from here the outlook is a little bit more positive.
Yeah, thanks, Richard. And I think, again, one of the other interesting trends from recent months has been investors transferring significant cash holdings from bank deposits and something you've talked about previously into money market funds. Just going back to that, point on short-dated government bonds in the UK, short-dated gilts, do they offer an attractive opportunity for individuals who are seeking a higher yield from a lower risk segment of their investment portfolio?
Yeah, I think absolutely they do. There's different ways you can do it, and the kind of almost have to consider the tax position as well, because some short-term investments are more efficient than others as far as higher rate taxpayers are concerned. But even if you are a higher rate taxpayer, you can get yields net of tax in excess of around 5% on short-term gilts. So I think they may go up, the yields may go up further depending on what the Bank of England does, but I think relative to what is offered on deposit sometimes, I think this is a pretty attractive opportunity to lock in yields of above 5%.
Great stuff, thanks. And just finally, again, taking a step back and looking at the global economic outlook for the second half of this year, it's been a constant narrative in 2023, but again, I think it's fair to continue to say that we remain in a period of heightened uncertainty in terms of potential outcomes. And you referenced earlier evidence of unexpected economic resilience. We're also facing the challenges of supply constraints. Sticky inflation is continuing to raise a number of challenges. And I think all of these are prompting investors to ask, where next for central banks in terms of their approach to rates. So what are your current thoughts on this question? And also kind of just looking forward, what should people be looking out for over the forthcoming weeks when thinking about this question?
Yeah, I would say that stuff comes out of nowhere sometimes. So whether that was sort of Silicon Valley, the first half of the year, or the mini budget, stuff happens that affects what central banks do or affects the outlook. But those things are very hard to predict at the best of times. I think the overall message probably is that we are hopefully getting close towards the end of the interest rate tightening cycle. But the key thing, I think, is going to be obviously whether inflation stabilizes, and particularly core inflation starts to come down, as we hope it will. But then also the labour market. I think as long as unemployment is low, as long as wage growth is strong, central banks have got a bit of an issue. They can't really take the foot off the brake too much as long as you've got very tight labour markets. So the thing that I think I and a lot of other investors will be watching the most closely are things like non-farm payrolls in the US. We've got the next one out this Friday, and things like the job numbers in the UK and wage growth. Because, as I say, until we see some sign of softening on that front, I think it's hard to get too relaxed about where interest rates may ultimately go.
Thanks again, Richard. I think at this point, great to welcome Ben to the conversation. And obviously, Ben, welcome back, fresh from your recent research visit to the West Coast of the US. And a quick glance at the names dominating headline equity returns in America this year would suggest it's been boom time once again for tech. And obviously that follows in the wake of last year's challenges. But clearly things are a little bit more nuanced on the ground. So kind of turning to your recent trip and the research meetings you had, what resonated most from those meetings with companies, and how is this shaping your outlook on the sector?
Yeah, thanks, Simon, and good morning. So yeah, look, I think I do this trip every year, and I think there were three key takeaways I was trying to get from this meeting. I had 18 company meetings over 4 days, and we went to see some enterprise software companies in San Francisco and cyber companies, and then we went down to the Valley and saw some semiconductor companies, and then to LA for some media companies, and then finally Seattle for these Microsoft and Amazon. You can't go to Seattle without seeing those two. So yeah, look, I think the three things would be the job market, macro, and what's happening in terms of AI. So let me just break those down. So, a lot of concern with some of the job cuts that you've seen from the big tech companies, that the job market, is going to struggle in tech. And I think it's different depending on the skill set that the people have got. So, tech developers are still very much a key asset. And if those are being displaced, then, they're finding new homes pretty quickly. We talked to some mid-sized software companies that were very happy that there'd been some job cuts at the big tech companies, because that was allowing them to do recruitment that they wouldn't have been able to do previously. The other area is, sales and marketing. And it appears those guys similarly are finding, new roles, although there is a little bit more slack in terms of sales and marketing roles in tech. But look, overall, I would point you to two stats. One, that 85% of people who've been made redundant in tech are finding roles within 3 months. So, there's a fairly quick turnover if people are displaced. And the second one is that actually the pace of tech layoffs has slowed quite markedly in the last couple of months. So in January, we had 108,000 job cuts, and that was about 50,000 through February, March, May, something like that. And then in June, that's slowed to about 12,000. So the pace of job cuts is slowing, and I think that's sort of reflective of a little bit of the macro, but certainly tech job markets still reasonably robust. Second area is macro, and it's very much the same pattern that I heard a year ago, actually, which is that deals are still getting signed, but there are some, macro push outs, some slippages. And I think this is probably, fairly clear that the CFO, when companies are trying to sign new software deals, the CFO is getting much more involved, and projects are only really getting approved if you're seeing, high time to value, fast time to value. So as I say, that's the same feedback I got a year ago. The only thing I would say is that companies, given the macro, given the interest rate environment, that money's no longer free, this pivot from growth to profitability is very much in place. And so the companies that are able to do that growth to profitability pivot are very much getting rewarded. The ones that can't, aren't. So there we are. The third piece is artificial intelligence. And I want to, zero in on one particular key debate, I think that's particularly poignant in software, which is the debate around how you price the infusion of generative AI into your software, because you're clearly generating a lot of value, but lots of software is sold on a per user basis or a per seat basis, as it's called. And so that's an issue if you sell software, because your customers have got two choices, really. They can either employ the same number of seats and get productivity gains, or they could employ less seats and do the same as they were doing previously, right? And clearly on a price times volume basis, if you're selling software and you're selling less seats, that's not very good for you, for your sales line, basically. And so this is still, very much debated. I think it comes down to what type of software you're selling and which part of the organization that addresses. If you think about sort of front office and sales driven software that's used in the sales process, for example, that's going to be far more protected in terms of the number of seats, because I think most companies in the world would prefer more sales from their existing sales force. Whereas if you're a back office application, you probably want to do the same, but with less people, right? And so that definitely skews the way that we think about investing in software, particularly enterprise software, going forward. Actually, it's all a little bit mute at the moment, because lots of these products that have generative AI infused into them haven't been priced. But the only one that has been priced so far is Microsoft have infused their Copilot technology, generative AI Copilot technology, into a thing called GitHub. GitHub is the library that software developers use, and they've priced it at 40% premium to the previous generation. And so you can see that there is a significant uplift if you can get your pricing right and your price times volume right for these companies. So yeah, those would be my three takeaways, Simon.
Great, thanks, Ben. Great to get an insight into the level of detail in the areas being discussed. It's something I alluded to earlier, but the subject of market leadership has dominated a lot of conversations this year, both internally here at Quilter Cheviot, but also, with investors. And I think one of the most interesting observations from 2023 so far has been just how significant the contribution from a handful of large tech stocks has been on that headline positive return that both Richard and I mentioned earlier. And interestingly, one stat I saw, the concentration of these gains has now surpassed the levels that we saw even in the early 2000s. So, a lot of that conversation has been around, the impact and opportunity from generative AI. You've obviously referenced it there. It feels like you've not really been able to have a conversation internally this year without the topic being raised. And obviously, you had an excellent webinar last week on the subject of investing in AI, which, for listeners is available on demand via our website. But I think just to summarize, are markets, in your opinion, over or underestimating the potential effects and opportunities of generative AI at this point?
Yeah, that's a great question. Thank you so much. Look, let's just go back to the performance over the half of the S&P and the Nasdaq. The S&P was up almost 16%, the Nasdaq up almost 32%. And if you break down the S&P performance, it's really been 10 companies that have driven 90% of that performance, and 8 of them have been to do with generative AI. The two that haven't are Apple, which has had its launch of its Vision Pro and has some good tailwinds in terms of sort of product announcements coming in the next few months. And the other one is Tesla, right? But they're still tech companies. The others have been Microsoft, the cloud providers, Microsoft, Alphabet, Amazon. There have been some software and internet companies like Meta and Salesforce, and then the semi companies like Nvidia, Broadcom, and AMD. And as I say, those 10 companies have made up about 90% of the S&P performance. Now, it's very interesting just to look at how the market has been sort of trying to price generative AI over the last 6 months, right? And so the initial winners were Microsoft and Nvidia, and I think those are certainly pretty interesting. But then we saw a company called Chegg, and Chegg does software for education, helping students learn and pass exams. And they said that they'd seen quite a significant reduction in the usage of their product because of generative AI. And then that led the market to sort of look for losers as well as winners from generative AI, and lots of the media companies got hit pretty hard. I think what's important to look for is products that have stickiness in terms of consumers. They're embedded in their workflow, and they already have existing sort of AI expertise, and that's super important. To answer your question directly around generative AI, it is a fantastic technology in terms of helping people do a number of things really, much better. So generating content, so the ability to generate images, or to be able to get to stop writer's block. Essentially, I want to write a leaving speech, or I want to write a wedding speech. It can help me, get to the start line quicker. Is it exactly what I want to say? No, but it can help me, generate content from a start. It's very good as well for summarization. It's very good for coding as well, right? If you give generative AI a relatively defined set of parameters, it can help you, do things like coding extremely well. And then it's also, good for knowledge workers, for searching and finding out information. However, what I do think is that, everybody's in this sort of excitement and knowledge building phase, and often and I've looked at technology for 24 years now, there is this hype cycle that we get in terms of technology. And so we've got to be very careful that expectations don't get ahead of reality, because often in hype cycles you have expectations get ahead of reality, and then there's a sort of trough of disillusionment where either regulation or the technology doesn't live up to expectations, or there are errors in it, and so forth. So I think you've got to be really super specific, because there are some companies that have sort of got tarnished with the AI losers bucket, and I absolutely don't think that is the case. And similarly, there are some companies that have got AI in their name and have done extremely well, and there's not a lot of merit there. So over the coming quarters, we're going to see this, and going into Q2 numbers, we're going to see whether this is actually impacting numbers. And my suspicion is that there's not going to be much generative AI in the numbers. Only really NVIDIA has shown that in their numbers so far. And so I would be positive on the technology, but everything has a sort of addressable market, and you have to be careful that expectations of that addressable market don't get overblown. Hopefully that helps, Simon.
No, that's great, Ben. Thanks. An excellent summary, I think, of what is a very fast-moving topic, and one that seemingly is very much kind of an unwavering focus for investors at this point in time. And I think if I can hark back to your recent trip as well, you outlined the fact that you were seeing a broad range of different companies, operating and focused on different areas of the sectors that you cover. We talked about the concentration of returns, but looking beyond that, I think it'd be really interesting to ask the question of whether you're seeing opportunities elsewhere beyond the Gen AI story. Is this the only show in town, or are there other interesting opportunities that are emerging, across your other areas of coverage?
I mean, the short answer is that Gen AI has very much found a fillip to revenues and to interest in technology at a time when macro was really taking its toll. Before generative AI, people were really worried about the macro. They were starting to look into sort of 2024, 2025 at a recovery, but as with lots of things, if you get a new technology, it can ignite and assert interest in lots of other areas. It's not been all plain sailing. If you're invested in analog companies, for example, that's not been particularly brilliant, and in industrials hasn't been particularly brilliant. Auto has been quite an interesting area, because clearly there's a lot more technology going into automotive. But we look at all the major areas of technology globally. So it's mainly the US and it's mainly Asia. And Asia, we cover companies like TSMC. That gives us an incredibly good read about what's going to happen to, smartphone shipments for Apple, and for PC shipments for companies like AMD and Intel, and for data center and auto and industrial and so on and so forth. So that's been that gives us a really good read. It's interesting. There are some niche plays in Europe as well. We've got the world's best semiconductor capital equipment company. They make the machines that make semiconductors in ASML. So that's been quite a standout as well. And then similarly, we've got one of the best power semiconductor companies in Europe as well, in Infineon. Unfortunately, in the UK, there's not a huge number of great technology companies to choose from. There used to be when I started my career, but through a series of takeovers and some fairly tough listing requirements, that pool has got significantly smaller. So, yeah, look, we try and look for the best world-class companies around. Gen AI is taking a lot of the narrative at the moment, but there are pockets of positivity and pockets of negativity as well.
Excellent. Thank you, Ben. Thanks also to Richard and to all of you for dialing in today. We love to hear from our listeners, so if you enjoyed our discussion, please review the show now wherever you're listening and share it through your social media channels, tagging us at Quilter Cheviot. And also, just as a reminder, to make sure you don't miss a future episode, tap the subscribe button as well. We will be back next Tuesday. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview to this podcast, as well as subscribe to our weekly comment newsletter. And you can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars, including, and it's a shameless plug, the forthcoming MPS in Conversation webinar on Wednesday, the 12th of July. All available on our website or through our social media pages. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, simply ask them via the weekly comments page on our website. Again, we love to hear your questions. And that's it for today. So thank you once again, Richard. Thank you, Ben. And thank you to you for your time today. And for all of you dialing in, we look forward to seeing you next time.